there are best practices that will help to not make your investors mad. There are some things that will help you out along the way because it can be really complex, really fast.
We are back with an episode, and today we're going to have this as a tool for this episode. We're going to talk about share ledgers and cap table. We're going to discuss the difference between them in a second. But how do you use them and what is it, and how can you use the cap table to impress your investors? So this is really good to know, and we're going to explain everything here. So stick around because you do not want to miss this one.
Perfect.
And Kat,
Yeah,
let's go.
let's go.
First of all, what is cap table and what is share ledger?
And they are not the same.
Okay.
That's number one, because often people do mix them up. So the share ledger or share register, that will be the legal document where you in detail, according to your jurisdiction's law, will list the current shareholders, their address, their personal ID or company registration number. So that will be quite a formal document.
Okay.
And the cap table
is but is it mandatory to have the share ledger when you start a company? Okay, then I'm with you.
Good question. It's mandatory, and that will regulate who, at each point in time, has the economic rights, saying that you're about to pay dividends from the company, and also it will dictate who has a right to show up at the shareholders meeting and actually cast a vote. So that's why it's such an important document to have.
Good. And then cap table. What is it?
Cap table, that's actually optional. So that can be what you want it to be, but as we will discuss, there are best practices that will help to, number one, not irritate or make your investors mad. Some things you should do and some things you should not do. And then also, there are some things that will help you out along the way because it can be really complex, really fast, and the cap table is used in a completely different way from the share ledger. And we'll get back to that.
Perfect. So we're going to start with an example.
Yeah, go to the basics, really.
Yes. So
the basics of the ownership of the company.
Yes.
And we're going to use an example here with Angelina and Brad. And they hold 50% each of a company. The company is worth 10 million. So basically, you could have one share each. So, and then that one share each will be worth 5 million, right? Because company in total was worth 10 million. So lesson number one is that you can have few shares. That's completely fine. But you cannot give away fractions of shares. So if you only have a few shares, and in particular if they're high in their value, that will be incredibly inflexible. Because imagine you want to bring in another owner, you do not want to give him 50% of the ownership stake. Then you have no way of going about doing that.
Okay.
So instead of having one share each, why not have 5 million shares each? And also, just as a basic, which can be confusing, is that Angelina, if she owns one share or 5 million shares in the company where she has 50% of the ownership and the company in total is worth 10 million, then she is as rich. The number of shares will not say anything about how much value, how rich she is. That will always be dependent on how many shares in total the company has issued and the value of the company. So regardless if Angelina has one share or 5 million shares, the 50% ownership stake will still be 5 million. But in this case, each share will be worth $1. And then the next a bit confusing part is if you bring on an investor that invests into the company, that means that you will issue new shares. So Angelina and Brad will still hold the same number of shares. What will be affected is instead their ownership. So let's say that we bring in two investors investing 1 million each, so in total 2 million. And that's Charlie and Douglas.
So I'm going to write, welcome to the company, Charlie and Douglas.
So they enter into the company at the pre-money valuation. Oh, since we have a price per share 1 million and we have 10 million shares, pre-money valuation will then be 10 million. If they invest in total 2 million, the post-money valuation will be 12 million. Based on that, we will find out how big their ownership stake is. And then we will take, since they have 1 million each, we will take 1 million divided into the total of 12 million. And then we will have approximately 8.4% ownership each.
So they have this for...
Price per share is the same, $1.
And we have an episode about post-money and pre-money as well.
Yeah.
Really good one.
Good to know. Which means that their ownership in regards to value and number of shares has not moved. But given that the cake is bigger now, they will have less of an ownership stake.
Okay, and this is because we calculated
the ownership on
post-money.
On the post-money, and the post-money now is 12, right?
Yeah.
So now we need to split it into the number of shares now is 12 million, and that's you will end up with the same result regardless of you calculate the value of the monies in this case or the number of shares. This is 1. But here, if you want to know the ownership stake, you will look at the number of shares, which means that you take 5 million divided into 12 million. And that will be approximately 41.6%.
Yeah.
So, and this will then be represented on the cap table like this. And you will be able to follow the new funding rounds. And we have one more basic before we go into the best practice, the 11th best practices that you should know about. And that will be to understand the fully diluted basis. Because this is the number of shares outstanding. But the shareholders and the future investors will also want to know if you have other securities such as employee stock options, convertibles, that will in the future be given right to shares in the company. Because if I look at this picture, it might give me a too positive view of what I will own and control in the future. Imagine that you also have a 10% ESOP pool, that's employee stock options. So we can add that of 10%. Because that means that if you can issue stock options today to them, they will not be part of the ownership and they will not be entitled to the economic or voting rights today. They will not be part of paying dividends, etc. But in the future, they will. So you as a shareholder will be as interested of the non-diluted and fully diluted, so you know what happens in the future. Let's say that then that we want 1,200,000 employee stock options, and then in total we will have 13,200,000 shares. So then we need to decrease everybody's ownership yet again, because then to find out how much the ESOP will control in the future, then you take 1,200,000 divided into 13 million, and that's the total number of shares and other equity. So let's find out how much does the ESOP pool have, and that will be approximately 9%, right?
Yes.
And that means that Charlie and Douglas will instead have 7.6% each, because now we take 1 million, and instead of dividing into 12 million, we will divide it into 13,200,000. And Angelina and Brad will also see their ownership stake decreasing. So you take 5 million divided into 13,200,000. And then we will have approximately 37.9 million. And rounding errors here, so bear with us. And that will make for a total of 100. Total equity in the company, not only shares, and the total on a fully diluted basis. If we're going to look non-diluted, then we'll stop here. Fully diluted, we include other equity
than the shareholders.
Yeah.
Okay.
And both are as relevant.